Meta Platforms, the tech giant once known simply as Facebook, has become one of the most talked about stocks of the decade. With a market value approaching the $2 trillion mark, billions poured into artificial intelligence and some of the most widely used social apps in the world, many investors see Meta as a long-term powerhouse. But recent moves have left analysts and traders divided, and some believe the company just missed a golden opportunity that could shape the stock's trajectory for years to come. In late 2025 and early 2026, Meta stock has experienced increased volatility. Shares briefly surged after a strong earnings report, with revenue and profits topping expectations and showing healthy ad business growth. This initially pushed the stock sharply higher, rallying investor optimism. But much of that early gain has since faded as broader tech sentiment cooled and concerns about Meta's massive spending emerged. At the root of investor frustration is the company's hesitation to execute moves that many believe could unlock latent share value, most notably, the decision not to enact a long-anticipated stock split. Many shareholders saw this as a missed chance to make shares more accessible to smaller investors, often a catalyst for renewed retail buying and price momentum. With Meta nearing a valuation milestone that would place it firmly in elite company among global tech giants, critics argue that the timing was perfect for such a strategic move, and by passing on it, the company left money on the table. Beyond short-term trading dynamics, the bigger story revolves around Meta's strategic bet on artificial intelligence. After shifting away from a heavy focus on the metaverse, a foray that resulted in massive losses, leadership has doubled down on AI as the defining technology of the next decade. Billions are being deployed toward infrastructure, AI research, and next-generation products such as AI-enhanced advertising tools and augmented reality devices. The company's new AI division, Meta Superintelligence Labs, is at the center of this shift, aiming to push the boundaries of machine learning and superintelligence research. Yet this transition hasn't come without cost. Meta's expenses have ballooned, with capital expenditures projected to increase substantially in 2026 as the company builds out compute infrastructure and talent. In a world where Wall Street increasingly punishes heavy spending that doesn't immediately translate into profit growth, these outlays have weighed on the stock and made some investors wary. Even with strong top-line revenue increases led by digital advertising, margins have been squeezed, and the sheer scale of investment has triggered debate over near-term returns versus long-term innovation. Meta has also had to deal with challenges on multiple fronts. The company's suite of platforms, Facebook, Instagram, WhatsApp, and Messenger, continues to generate robust engagement, and revenue growth has remained solid, yet global regulatory scrutiny and shifting policy environments have created headwinds. Additionally, early investments in virtual reality and the technologies once seen as the future of immersive computing failed to gain quick traction, leading to layoffs and strategic pivots that highlighted how expensive and unpredictable such bets can be. For value-oriented investors, however, Meta's stock may still present an intriguing opportunity. Some analysts view recent sell-offs not as a warning sign but a discount window, a chance to buy shares at a softer price following sharp moves down. With a P/E ratio that looks reasonable relative to growth forecasts, and with advertising revenue proving more resilient than feared, long-term bulls argue the stock could rebound as AI monetization begins to pay dividends in earnest. Wall Street remains broadly optimistic. Consensus targets for 2026 suggest substantial upside from current levels, with several brokerages placing price goals well above where shares are trading today. At the same time, a few more cautious voices warn that Meta's valuation already reflects near-perfect execution on growth, leaving little room for error. If big AI projects or global expansion efforts fail to hit lofty targets, the stock could face downward pressure. In the end, Meta's story in 2026 is about transition and tension. It's a company reinventing itself in real time, trading short-term share price gains for long-term technological leadership. It's a narrative of monumental success tempered by immense spending and strategic pivots. For investors, the real question isn't merely whether Meta missed a golden opportunity, but whether the opportunities it is chasing today, especially in artificial intelligence, can justify the risks and ultimately drive value for shareholders in the years ahead.